Mortgage rates ticked lower, 6.36 as of market open this morning. But don't let the quiet fool you. This is the calm before the next big move. This week, we're going to dive into what drove the narrative, what that big move may look like, and how we can prepare our clients to take full advantage of the now and that possible next big move. So let's dive into it. This week, as I mentioned this morning, markets opened with rates ticking lower than last week, 6.36 on a well-priced 30-year fix, down from last week's 6.38. The government shutdown has left the market directionless, and that's why we've seen rates just oscillate in this window. Jobs, consumer data, CPI, PCE, PPI, you name it, the list goes on. Anything coming out of non-essential government reporting agencies is frozen until the government reopens. Powell spoke yesterday in pre-recorded comments. Market was acutely watching for any mention of monetary policy, and by surprise, he gave us absolutely no breadcrumbs. With that, the market just kind of shrugged it off. The Fed's minutes, though, were released earlier this week and again hinted to 2 additional cuts this year, which the market is very eager to see play out. However, that was hinged on, yet again, inflationary concerns, which was brought up, and also, of course, the labor market. Bonds drifted, 10-year Treasury, between an important range, 4.08 and 420, but ultimately bode well for mortgage-backed securities, which ultimately, as I mentioned earlier, have remained really in this similar trading pattern, leaving rates ultimately in its same range. Despite all the chaos, despite all the fears, mortgage rates have ultimately not responded in its volatile-like manner. So what does this mean for our clients? Why is this moment important, and what the next move can look like? As I opened with, this is the quiet before the chaos. This is the time to capitalize on fear in market of, hey, what happens next? I can't tell you how many conversations I've had with clients this week of this time, this moment is really eerie compared to what we saw. Eerie in the sense that it's very similar to what we saw in that back end of the COVID chaos. This is the time for clients that have paused for rates, wanting to see what the market is doing. There is so much opportunity, new listings, you name it, where clients can finally take advantage, as I've mentioned before, a buyer's opportunity that we have not seen in close to a decade. Take advantage of the opportunity that presents itself now. Interest rates, yes, where they're not favorable, they are still lower than where they were this time 2 months ago. The data drought will end soon. The government will reopen. We all know that. We just don't know when. And when it does, we're going to see volatility kick up like nobody's business. Right now, again, as I mentioned earlier, rates are still favorable. Take advantage of the opportunity now. And the lock-in effect, as we've discussed, individuals being stuck to mortgage rates sub 4%, is starting to ease. We're seeing transactions come out of people who pause. This, again, is the opportunity we've been waiting for. Now is the time to capitalize. Rates are steady now, but the market is coiled tight, so tight. Once the data starts flowing again, we'll see movement fast. Stay ready, stay informed. And as always, if you feel anyone can benefit from this information, please forward, share, like, comment, and subscribe. As always, let's make it a fantastic Friday and an even greater weekend. Thank you now.